Mortgage rates are now the highest they have been since before the global financial crisis in 2007, and housing affordability is at an all-time low. This, amongst other turbulent economic conditions, is painting a grim picture for the housing market, in which the outlook for the next few years could be devastating. Big global banks like Goldman Sachs have even made a case that a housing market crash worse than 2008 is on the horizon right now. Today I'll be taking a look at the current economic data, as well as the key arguments why we could experience a catastrophic housing market crash in the near future. So first of all, let's take a look at the consequences of sky-high mortgage rates. So the average 30-year fixed-rate mortgage in the US is increasing by the week at the moment and is now up to 6.92%. So this is now the highest mortgage rate that we've seen since just before the global financial crisis in 2007, in which the housing market totally collapsed. Now, just 1 year ago, average mortgage rates were sitting at around 3%, and a rapid surge in the mortgage rate is making housing affordability much worse for people looking to buy a home right now. For example, in January of 2021, when mortgage rates were 2.65% on average, if you took out a mortgage for $450k on a property that was worth $500k, you'd be paying $2,208 per month in mortgage payments. But fast forward to today, with the current mortgage rate of 6.92%, this same $450k mortgage for a $500k property would cost you $3,364 a month, which is a whopping 52.3% higher in terms of the monthly payment for the same loan and same property valuation. So ultimately, these sky-high mortgage rates are making housing very unaffordable right now, and something does have to give. It's therefore quite likely that housing prices do drop somewhat significantly from here due to the far lower market demand as a result of the unaffordability. So as a result of these high mortgage rates, mortgage purchase applications for the last week of September were down 13% week over week and are now at the lowest level that they've been since October of 2015. So mortgage purchase applications are also now down by 37% compared to last year and are now also at a lower point than the spring 2020 lows that we saw. So Redfin Deputy Chief Economist Taylor Marr recently said, "Sellers are pulling back in this market, but buyers are also pulling back even more. Home prices are holding steady for now. It will take a few months before the prices of closed sales start to reflect this shock to the market. However, there is evidence of sizable price declines in parts of the market that aren't accounted for by MLS data, such as home builders offloading homes in bulk at a 20% discount." So with mortgages so expensive right now, many people simply cannot afford to take out a mortgage full stop. And this is clearly being reflected on the mortgage applications, with the likelihood that they will drop further as interest rates continue to rise. So data from mortgage data provider Black Knight does show that median home prices fell by 1.05% in July, followed by a 0.98% decline in August. Now, these 2 months mark the largest monthly declines since 2009 and suggest that the US housing market really has taken a turn for the worse. So 2 straight months of significant pullbacks in the market is something that was long due after 2 years of incredible growth, especially now that the market conditions are turning and the future economic outlooks are starting to look quite bleak. So we know that surging mortgage rates are driving housing affordability to the lowest level it has been since the 1980s, and it is likely to continue to get worse as the Fed is forced to keep raising interest rates in order to tackle extremely high inflation. And we can also see that US housing futures are down 5.5% since August, which is a sharp decline in such a short period of time, and it is somewhat reminiscent of the price action that we could see just before the housing market crash in 2008. So we know that rising interest rates is clearly driving buyers away from the market due to how costly it is now to take out a mortgage. Buyers simply cannot afford as much as they could do last year, and many are waiting in anticipation for mortgage rates to fall in the future. However, on the flip side, these rising interest rates are also de-incentivizing selling, which is also helping to balance the market somewhat right now. So people who bought their home over the past few years were likely to have locked in low mortgage rates for the foreseeable future, meaning that they will be very reluctant to sell their home and give up this favourable mortgage rate, only to take on a new mortgage at a much higher interest rate for the home that they're going to move into. So the fall in demand for homes is therefore being somewhat offset by this fall in supply from people who would be selling, as these people have sort of been trapped into sticking with their current home in order to keep their low interest rate mortgage. However, the key thing to note here is that if economic conditions continue to worsen across the economy, as well as once people on variable mortgage rates just cannot afford to keep up the payments as the rates continue to rise, the number of distressed sellers will surge and could flood the market with supply of homes in the future. Now, these sellers may not want to sell their home, however they could end up in such a dire economic condition and situation that they may have no other choice but to actually sell their home and to either downsize or to go into the renting market. So we also have a number of other turbulent economic conditions in the market right now, which is also negatively affecting the housing market. So higher mortgage rates is not the only negative thing that comes with interest rates rising. Historically, unemployment is also highly correlated with interest rates, and as interest rates get higher, unemployment usually follows closely, but lagging behind by several years. Now, looking at historic interest rates and unemployment over time, we can see that in the period of time from 1960 to 1980, interest rates did rise from low single digits up to as high as 20%. And in this same time period, unemployment did rise from below 5% to being over 10%. Now, similar patterns also did happen between 1980 and the early 2000s, where we saw interest rates drop from 20% down to below 5%, and unemployment did also fall from the original over 10% to being below 5%. And then again, also in the early 2000s to 2010, where the interest rate rose from low single digits to above 5%. This did lead to unemployment also rising from around 5% to around 10%. So there is a definite trend taking place here, and it does make sense when you think about the consequences of rising interest rates on the labour market, as there is less borrowing of money, which means less investment and also less business growth. And additionally, high interest rates does incentivize consumers to save more money rather than to spend it, having a negative impact on corporate profit and in general tougher market conditions for them to sell products and services in. So this therefore leads to less new job openings, as well as existing businesses laying off staff to reduce their workforce. So taking all of this into account, it therefore makes sense to assume that the higher the interest rate does go in the future, the higher that we are likely to see the unemployment rate go. And also with inflation still being extremely high right now, it's therefore quite likely that the Fed will continue to hike interest rates for the time being in order to continue to fight against inflation and to bring it back down to normal levels. Now, unemployment is currently at historically low levels of 3.5%, so it definitely has potential to rise quite a bit, especially considering that we do still have relatively low interest rates right now compared to what we've seen in the past. And in the future, as unemployment does increase, we're going to see demand for homes dry up even further, as there will be less people in a position to be able to afford to buy a home if they have no job or no income actually coming in at all. Now, as I previously mentioned, the demand for homes is getting so bad right now that home builders are trying to offload homes in bulk at discount prices. Now, builders have too much home and land inventory on their hands right now, and they're desperately trying to offload it onto buyers. Now, home builders enjoyed a booming business period during the pandemic period, selling to traditional buyers, but with economic conditions taking a turn for the worse, including, most importantly, rising mortgage rates, buyers are quickly disappearing in the market. Now, at a total national level, we can see that the housing inventory is indeed rising at a fairly fast rate, now up to around 732,000 homes, which is more than double what we saw of 347,000 in February earlier this year. Now, this is again a sign that the balance between supply and demand is shifting in favour of the supply, hence the build-up in overall active listings right now across the US market. And then we also saw Morgan Stanley come out last week and say that they expect home prices to fall by 7% by the end of 2023. So on the surface, this may not sound like a lot, but it would mark the second sharpest drop since the Great Depression if it does come true, as that would be a long way to fall in just over a year in time period. However, Morgan Stanley did also have a more bearish prediction in the case that the US falls into a recession, which seems all but likely at this point in my opinion. And in this scenario, they believe that the home price decline could exceed 10% by the end of 2023. Now they add that affordability is already challenged, exposing would-be homeowners to an increasing rent environment that erodes the ability to save for a down payment. Now combined with increasing unemployment, they imagine a scenario in which existing home sales continue to outpace the great financial crisis of 2008 on the downside. Now it's definitely concerning to hear Morgan Stanley researchers say this, and especially if we enter a recession, how they believe that house prices are going to decline at a faster pace than what happened in the great financial crisis, and it certainly does send a big warning to the housing market. So when we take all of this into account, we're definitely seeing some very bad data and very bad conditions for the housing market, which could only get worse in the near future. Mortgage rates are likely to continue to go higher as interest rates do get higher as well, which could in turn increase the unemployment rate, which would mean less people can actually afford homes. And we're also seeing supply obviously rise up as well, as the inventory levels are reaching levels that are a lot higher than what they were in the past couple of years. Ultimately, nobody knows where the economy and the housing market is going to end up over the next few years, but the data right now certainly does paint a fairly bearish picture. So that is all for today's video, guys. Please remember that this video is purely based on my own research and my own opinions. It's not financial advice, it's for purely entertainment purposes only. But if you did enjoy the video, please remember to leave a like, as that does help out the channel a lot. Also drop me a comment as well, let me know what your thoughts are on the housing market right now and where it could be heading in the future. And also be sure to subscribe as well if you want to see similar videos to this in the future. But apart from that, guys, thanks a lot for watching.